So let's get some more perspective, more reaction, if you like, to these figures and indeed what they mean for rates policy. My next guest spent 6 years at the Bank of England forecasting developments in the UK and in European economies. His name is David Tinsley. He's now the UK economist at National Australia Bank, based in London. Joins me from their offices. Mr. Tinsley, thank you very much indeed for speaking to us. Great to have you on the show. So, you know, as we're hearing there, we've got 4.5% for the month of May. I believe you're expecting something at the lower end, 4.4%. Perhaps a little surprised?
Yeah, I was a little bit disappointed by those numbers. I mean, going into the release, you had a fairly soft producer price set of data, and you had the British Retail Consortium saying that shop price inflation had softened. So I think the overall headline rate's a little bit on the disappointing side. It may dip a little bit in the next month or two as a result of the feed-through from lower oil prices on petrol prices, which is obviously delayed, I think, in the UK data. And thereafter, though, it's going to rise again as a result of utility bill hikes and probably skirt close to 5%. So I think it's going to be a choppy path this year for annual inflation. It's going to remain high, basically.
OK, so a choppy path, but you're expecting something more to the higher side, as you're saying. Could we then, does that mean we could possibly see something above 5% later this year?
You could see something above 5%. I mean, I think you are going to need a fair wind to get above 5%. The utility bill hikes that are going to come through in August and September are probably going to add about 0.3, 0.4 to the annual inflation rate, and that gets you to 5% thereabouts. A lot will then depend on what happens on global commodity markets for food and also, of course, for oil. If those prove firm, then I guess, yes, annual inflation could breach that 5% level.
So what does all this mean for rates? What are the implications? Increasing pressure for there to be a hike in the benchmark rate soon, immediately?
No, it doesn't mean anything for rates, really, to be honest. The MPC members' paths, voting intentions are really set in stone at this point. You've got two members of the MPC, possibly joined by a third down the tracks, who are voting for a hike. The rest of the committee are going to carry on voting for no change in policy. They say all this high headline rate of inflation is transitory, really. They think it's going to drop away next year. They're not going to change their minds. They're looking for the first hike coming in, perhaps this year, perhaps November, but quite possibly not until February next year.
I guess we're still talking about inflation being more than double the government, the bank's target. What do you make of Martin Wheel's argument that we need to see a rate rise now, just so that the government can hit its inflation target, well, not even any time soon, but in 2 or 3 years' time?
Well, I mean, there's some merit in his argument, but his argument really is that the bank needs to have a little bit in reserve in case the economy is softer next year, and that gives it the ability not to raise rates so steeply in 2012. But of course, really and truly, the economy is very weak now. It's basically final private sector demand is flatlining in the UK. So I think there's a little bit of a curious argument to raise rates against that background. I think the body of the committee really is looking to keep rates unchanged. There's obviously going to be continued arguments on the committee about that, but I don't see it changing.
And David, given the weak data that we have had recently that you touch upon, do you still expect to see a quarter-point rise in November?
That's our central expectation, but I think the risks are now skewed to them waiting until after Christmas. The Q2 GDP data is going to be a mess with the royal wedding effect, the earthquake effect, etc., really making those data very hard for the MPC to interpret. So I think really the MPC come November is going to have some data from which to gauge the underlying strength of the economy, but not a lot. So it may well choose to wait until Feb before going.
I mean, you know, it seems that expectations keep on being pushed back in terms of when we expect a rate hike. And I mean, you know, we have had weak data recently based on the information that we've had in the past, over the past few months, that we've had now indicating softer, weaker economic growth going forward. I mean, what guarantee is there really that the economy will be able to withstand a rate hike, whether it's November, December, January, February?
Well, there's no guarantee at all. Final private sector demand, as I was saying, is basically flatlining in the UK. The hope, and I think this goes for some of the international slowdown we're seeing at the moment, really is that fallback in oil prices, and as some of the Japanese earthquake effect unwinds, we'll see a firming in activity in the UK and also in the States in the second half of this year. But if that doesn't happen, then that isn't going to be an environment in which you can raise bank rate.